we'll show you a powerful trading setup that can help you enter high risk to reward trades with the potential for significant profits. In this video, you'll learn in detail how to combine volume with price action to find high probability trade setups. The price of any stock can be manipulated, but one thing that cannot be manipulated easily is volume. If you've been consistently losing money in trading, this video is for you. After watching it, your perspective on trading may completely change, and with proper practice and discipline, you can gradually become a more consistent trader. This is a setup that I personally use, and it has worked very well for me. But before learning the strategy, let's first understand what volume actually is. Volume tells us how many buy and sell orders were executed during a particular period of time. For example, if we're looking at a one-day time frame, each candle tells us where the market opened, where it closed, how high it went, and how low it went during that trading day. Below each candle, you'll see the volume bar, which shows the total quantity of shares traded that day. Keep in mind that executed buy and sell orders are always equal. For example, if there are buy orders for 120 shares but only sell orders for 100 shares, then only 100 shares can actually be traded. The remaining 20 buy orders stay pending. So, the total executed volume for that day is 100 shares. Whenever you notice unusually high volume on a chart, it means a large number of buyers and sellers participated during that period. However, we don't take trades based only on high volume. We'll use several confirmations before entering a trade, which can significantly improve the probability of success. Trade entry rules. Rule number 1, the stock must already be in a strong uptrend, making higher highs. How do we find such stocks? Simply search on Google for 52-week high stocks. Open the Money Control website, where you'll find a list of stocks trading near their 52-week highs. Add these stocks to your trading view or broker watch list. Now let's look at the actual trade setup. Rule number 2, the chart must form a continuation pattern, such as ascending triangle, flag and pole. Many traders lose money because they trade chart patterns randomly without understanding which pattern works best in which market condition. Rule number 3, enter the trade only when the price breaks above the high of the breakout candle. Rule number 4, before the breakout, volume should gradually decrease in descending order. This means the volume bars become smaller and smaller during consolidation. Then, on the breakout candle, volume should suddenly increase and be larger than the previous volume bar. Only then should you consider entering the trade. Stop loss and exit strategy. There are 2 ways to place your stop loss. Place it below the low of the breakout candle. If the recent swing low is nearby, place the stop loss below the swing low. For exits, you can use 2 methods. Method 1, use a fixed 1:3 risk to reward ratio as your minimum target. Method 2, apply the 9 EMA on your chart and stay in the trade until a candle closes below the 9 EMA. Personally, I prefer using the 9 EMA because in swing trading, once a stock starts trending, it often continues moving higher for several days or even weeks. Let's understand this with an example. On the screen, we have the IRFC daily chart. The stock is already in a strong uptrend. Notice that while the price was moving higher, volume was also increasing. This confirms that the uptrend is genuine and supported by strong buying interest. No one can predict the very first uptrend. However, we can identify the next potential uptrend, and that's exactly what we're trying to trade. During the rally, the stock formed large bullish candles. During the pullback, it declined slowly with small bearish candles. At the same time, volume kept decreasing. This is known as volume dry up, which indicates that the pullback is weak and sellers are losing strength. Now draw a trend line over the pullback. This forms a continuation pattern. When the price breaks above the trend line with strong volume, we pay close attention. You'll notice that there were previous high volume candles, but they didn't break the trend line. The actual breakout candle is the one that breaks the trend line with significantly higher volume. Once the next candle breaks above the high of the breakout candle, we enter the trade. Our stop loss goes below the breakout candle's low, and our exit is either at a 1:3 risk to reward ratio or by following the 9 EMA until a candle closes below it. Another example. Later on the same chart, after a strong rally, the stock starts consolidating again. The price gradually moves lower, and volume continues drying up. Draw another trend line. Eventually, one candle breaks above the trend line with the highest volume compared to previous candles. This becomes our breakout candle. When the next candle breaks its high, we enter the trade. Again, place the stop loss below the breakout candle and exit either using a 1-3 risk to reward ratio or by trailing the trade with a 9 EMA. If you observe carefully, during every strong uptrend, price kept making higher highs while volume also increased. This confirms that institutional participation was supporting the move. Conclusion. In this video, we learned how to combine volume and price action to identify high-probability trading opportunities. Like every trading strategy, this setup requires practice, patience, and discipline. Before risking real money, practice this strategy through paper trading or a demo account. Once you become comfortable and consistently profitable in practice, then consider applying it in live markets. Remember, no strategy guarantees profits, but proper risk management and discipline can greatly improve your long-term trading performance.